Hey dividend growth investors, bonjour. Welcome to this video where I discuss all the trades I've done during the holidays to set my portfolio straight for 2024. You know, every year I spend a time where I cut down the noise and then I review my asset allocation, my sector allocation, and all my stocks. I trim some, I sell some, I buy some. Most of the years I don't do that many trades, but this specific year at the end of 2023, I did 8 trades. I know it's a lot, but it was necessary to make sure that my portfolio remains healthy and increase its dividend for the next year. So let's get started with 2 stocks that are not in my portfolio anymore. So the first one, Disney, ticker DIS. This one, I bought it in 2017 based on the investment thesis that this company is acquiring more and more characters and content in franchise such as Pixar, Marvel Studios, and Star Wars with Lucasfilm. They were growing with park themes, movies, and so on, and they even had later on a special project with their streaming services. So everything looked great until COVID hit. And then they suspended their dividend. Usually it is a hard rule for me where whenever a company cut or suspend its dividend, it's over. I just sell it and I move on. It has been a great strategy for me in the past, but this time I made an exception because it was not really Disney's fault if they could not open their park theme and all movie theaters were closed, right? So for that reason, and because the rest of the investment thesis was still very strong, I held on to those shares. In 2021, their streaming services were booming. Everybody was super enthusiastic, and then the stock price got rocketed again. And then I thought, you know what? I can wait a little bit more, even if there's no dividend payment, because again, the dividend, my investment thesis remains very strong. Fast forward today, revenue continued to increase, which is great, but Disney Plus has become a money pit hole. And I don't want to see Disney burning cash for several years. And as you can see on this graph, the earnings are pretty far away to what it used to be back in 2018, 2019 before COVID. They did reinstate the dividend, but it's a small payment. It's too little, too late on this one, and I just decided to move on, mostly because I don't see that as a strong dividend grower at this point. I think they have a lot of other problems to deal with, and at one point, it's just a small portion of my portfolio, just a very tiny exposure to Disney. I just decided to sell and move on to cut down that noise. The other exception I made in my portfolio as to my rule to sell when there's a dividend suspension was CAE, and it was exactly for the same reason. Before COVID, CAE was thriving. It is the world's largest pilot simulator, so they're training civil pilots and they're also training military pilots with their simulators across the world. They grow by acquisition. There was a perfect business with a strong dividend triangle. With the COVID, well, nobody was flying anymore. They had to suspend their dividend. They were not too sure what's going on with the business, and that's totally fine. When they saw an opportunity, they saw that they could make a big benefit from the COVID, where they started to acquire competitors at a pretty cheap price in 2020 and 2021, which I kind of like. So that went along with strengthening my investment thesis in this company. The stock price has recovered partially. The revenues are going up, but the earnings are a bit shaky. At this point, it was an upsetting trade because I still believe CAE will do well in the future. I still have a strong investment thesis for this one, but it's not a dividend payer anymore. And my investing strategy is all about dividend growth investing. So if a company doesn't grow its dividend and this one it's not even paying one, well, there's no place for it in my portfolio. So those 2 trades, Disney and CAE, they were small position in my portfolio and they do not pay a dividend, or for Disney it was like too little, too late. So at this point, it was more about realigning my portfolio with my core strategy. Once I've reviewed all my stocks one by one, that was great. I got rid of 2, but after that, there was a next step, and it was to look at my top positions, because you want to make sure that you let your winners run, but you're not overexposed. In my portfolio, I've set a hard rule of 10% for a stock. So I let that winners like outperform everything for a very long time, but at one point, it's enough. I need to minimize my risk and get rid of that huge exposure. So I started trimming Alimentation Couche-Tard in 2023. As you can see on this graph, very strong dividend triangle. The stock price more than doubled in the past 5 years, which also is in line with the earnings per share. So you're not paying more today than you were paying 5 years ago, and the company is still on the growth mode. So I want to let it grow in my portfolio, but when it hit 10%, I just trim it a little bit just to make sure that I'm still well diversified. And if ever ATD fails me, it's not going to be a major catastrophe in my portfolio. Another one that I tend to trim on a regular basis, it's been the third time I'm selling shares, and it's Apple. I first bought Apple in 2014, so you can see how big of a profit I made on this one, and at like every 2-3 years now, I have to trim it a little bit for the same reason. For Apple, as you can see, the dividend triangle is starting to stagnate in terms of revenue and earnings, but the stock price is still very healthy. So for me, it was a great timing to reduce my exposure to an amazing company, but still shows some signs of weakness at this point. Nonetheless, Apple still is a strong cash flow making machine. I'm confident that will continue to grow their business going forward. But in the meantime, I just want to make sure that, again, I'm well diversified. So it was a great time to sell high and buy something else to rebalance my portfolio. Last but not the least on that trimming list, well, Microsoft, second time that I'm trimming my position. The first time was in 2021. Now this time again at the end of 2023, mostly for the same reason. So the dividend triangle is amazing. They still have major growth vectors with the recent acquisition of Activision Blizzard, the trending artificial intelligence opening new doors and possibilities, and riding the cloud business with Azure with double-digit growth year after year. Microsoft is really thriving. The rich valuation also tempted me to sell a few shares because right now we're trading at over 30 times its earning. So with a PE ratio over 30, I thought, you know what? It won't hurt if I sell 1 or 2% of my portfolio of Microsoft. I still have a pretty solid shares of those, pretty solid position, sorry. So I will be able to continue to benefit if Microsoft continues to thrive. In the meantime, I just wanted to reallocate that money elsewhere across my portfolio. So here's come the most interesting part, the buying stuff. So the first one I bought with the proceeds of my CAE shares and a little bit of trimming for Alimentation Couche-Tard was another Canadian company, Stella-Jones. I discussed Stella-Jones not too long ago on my channel, so you can go back in the first week of the year 2024. I discussed like 4 Canadian stocks that I love. Stella-Jones was one of them, so I bought it a few weeks ago. What I like about Stella-Jones is even though it's in the basic materials sector, they have a well-diversified business and they have several growth vectors. Even better, their long dividend growth rate streak shows us that the company is able to increase its dividend even during a recession. So the company can count on utility poles, railway ties, and residential lumber. So of course, residential lumber may not be the one that will thrive in 2024, but the other two are super solid, and Stella-Jones grows by acquisition on top of that. So there's plenty of growth to come, and the P ratio is still pretty much in line with its average. So even though the stock price rised in 23, I don't think it's overvalued at this point, hence the reason why I bought it in my portfolio. The next one that I added on my portfolio on the US side, because I trimmed a lot of US position on top of selling my Disney shares, and it's Automatic Data Processing. So largest payroll provider in North America, a very sticky business model because as an employer myself, I don't change my payroll suppliers. I mean, you get one, it's working, and there you go. It's kind of like a subscription business model where you just pay every year, the prices increase, and then you just follow. The company shows a very strong dividend triangle with steady revenue, steady earnings, and steady dividend increases. The company expects high single-digit to double-digit growth going forward. I'm super confident that this one will work for several years still because they have attached so many major employers in the US. Last but not the least, a small position I started. So I started a small position in LeMaitre Vascular, LMAT, mostly because it's a niche business, relatively small cap, so I don't want to take too much risk here, but I really like the business model where they are a supplier of niche products to hospitals, dealing mostly with surgeons. So pretty niche, but they're number one or number two in each of their market. They grow by acquisition, which supports a steady revenue increase, but most importantly, they have zero debt. And if a company has zero debt and grows by acquisition, I mean, this is definitely something I want to look into. And then when I look at the earnings going up and then the dividend going up even faster, I'm super excited of having LeMaitre Vascular. As I said, small position on this one. I don't want to go overboard with small cap because I know the risk. They're more volatile. But when a company, especially when a higher interest rate environment, has no debt, well, this is something that I would like to have in my portfolio, and it gives me a little bit more exposure to the healthcare sector, which is a small sector in my portfolio as well. Speaking of which, let's take a look at what it looks like in my DSR Pro dashboard. So Dividend Stocks Rock offer all their members to build as many portfolios as they want. So you can build like 7 portfolios if you want, and then you have the choice of looking at each of your portfolio individually or having a global view so you know exactly where you stand. So what you see here is my pension plan account where I do not add capital because it's a locked-in RRSP, a Lira account. So no capital goes in, and obviously I'm not withdrawing from it. I started this portfolio with $108,000 back in 2017. I'm now up to almost 240, which is great. The dividend yield on this one is quite low at 2.11, but if you go down the dashboard, you see the past 5 years of my dividend growth rate for that portfolio is over 10%. So definitely low yield, high growth type of portfolio models. As you can see as well in terms of sector allocation, I am invested in several different sectors, not too much into a specific one. I have great pro ratings and great dividend safety scores, so all indicators are towards the green side, which is exactly what you want when you start a new year. So you want to feel confident, you want to make sure that your portfolio is healthy and that the dividend will continue to grow. Well, when I look at this dashboard, I'm like, yeah, I'm pretty solid here. The second part of the dashboard where you see dividend diversification, the dividend forecast, and the dividend calendar is particularly useful if you are retired or about to retire, because then you know about your income source diversification. You do not want to have one stock paying 25% of your retirement budget. You want to have many different companies that will support your lifestyle at retirement. So if there's any problem with one stock, your retirement is not in jeopardy. The dividend forecast at my age doesn't really care, but if you're about to retire, you might want to look at this one so you know which month how much you receive, so it's easier to manage your budget. And as you can see on this example, there's 1 month where I get most of my dividends. So definitely if I was going to retire today, I would have to sell some shares or average down with a cash reserve to make sure that my income is more stable. So as you can see, I did a lot of trades, but it was mostly rebalancing and realigning my portfolio towards my core strategy, which is dividend growth investing. This portfolio is definitely a low yield, high growth stock portfolio model, and I believe it's the best way, it's the safest way to create a dividend income for life. Speaking of which, I've created a guide explaining you why low yield are safer and better than high yielders. You can download it in the link description below. You'll see the difference between the two types of businesses and the impact on your retirement moving forward. And it's going to shock you for sure, because there are some problems with dividend investing, especially if you focus on the yield. So the low yield, high growth approach will solve that problem. All right, guys, don't forget to subscribe to the channel to not miss my video every Thursday. And until next week, don't forget to stay invested.